The global packaging industry relies on a continuous flow of polymer films. When that flow encounters friction, price shocks ripple across the manufacturing sector. This friction is currently visible in the Ahmedabad industrial market during the fourth week of July 2026. This chart tracks pricing for commodity BOPP TT film, 31 to 50 micron grade. The baseline represents the official producer rate of 169 rupees per kilogram. However, the open market has detached from this baseline. Secondary trades are clearing between 171 and 172 rupees per kilogram. This data is sourced from Polymer Bazaar's Regional Market Intelligence Report. In commodity trading, a 2 to 3 rupee spread is a significant structural discrepancy. Misreading this shift can eliminate a buyer's entire quarterly profit margin. When open market prices rise while official rates remain static, procurement officers often assume downstream consumer demand is increasing. In this instance, the data suggests that assumption is incorrect. This model illustrates phantom demand. On the left, we see the common assumption, a price increase driven by aggressive consumer growth. On the right is the reality in Ahmedabad. Consumer demand remains flat. The price movement is driven entirely by a contraction in supply. The upward pressure is caused by localized supply delays and a strategic reallocation of inventory toward export markets. Mistaking a supply shock for a demand boom leads to overpurchasing, which creates high inventory costs when the supply chain normalizes. To understand the contraction, we must look upstream. Polymer producers are managing spikes in raw material costs caused by geopolitical friction. Instead of revising official domestic rates, producers have adjusted their output allocation. They manage this through two primary product categories: TT, or tape textile, for domestic use, and NTT, or non-tape textile, for export. This diagram isolates a single producer. The margin calculator shows NTT export grades generating higher net returns per ton than domestic TT sales. Consequently, producers have initiated an export pivot. They are fulfilling existing domestic orders, but directing new output toward international shipping routes. The shortage of TT film in Ahmedabad is a margin-driven reallocation of output by upstream producers. Downstream, packaging manufacturers, known as converters, must manage the impact of this reallocation. Converters typically operate with low raw material inventories and have little buffer against delivery delays. These factory lines require continuous operation. If a producer delays a shipment, the converter faces an immediate operational crisis. As inventory levels drop, the converter is forced to bypass their primary producer and tap the secondary market, paying the 172 rupee price point to maintain production. This 2 to 3 rupee premium is a cost paid by converters to ensure their facilities remain operational. Local producers cannot maintain this restriction indefinitely. The broader Asian macroeconomic picture is shifting. Price gaps between regions eventually attract lower-cost inventory from global markets. This map shows the incoming supply shock. Large volumes of commodity-grade BOPP are currently being staged in Chinese and Southeast Asian ports. These shipments are in transit, with an expected arrival at Indian ports in August. This incoming supply limits how long local producers can restrict domestic availability before buyers transition to imported materials. Producers face a final constraint on their pricing power: the threat of material substitution. In flexible packaging, BOPP competes directly with BOPET. This chart tracks the price trajectories. As the BOPP premium rises while BOPET remains stable, the price gap widens, making BOPET attractive. This horizontal line marks the substitution threshold, where the cost of BOPP covers the capital expense to retool machines for BOPET. Crossing this threshold causes an immediate lost sale and prompts customers to permanently remove BOPP from their packaging designs. Long-term demand destruction is the consequence of overextending a supply-driven price hike. Analyzing the structural pressures in the current market indicates that aggressive rate hikes by producers would be a tactical error. Maintaining stable baseline prices is the only path to retaining market share. The opportunity for arbitrage is narrowing. August imports will address the supply deficit, and the BOPET price gap threatens permanent material substitution. Macro forces in global trade often override localized market maneuvers. In a volatile market, survival depends on a buyer's ability to distinguish actual consumer demand from the temporary effects of a disrupted supply chain.